Okay, first up this evening is going to be Tatiana's Tortellini, which was part of the October 3rd update. So, cash flows from operating activities. What do? We start with our net income, and then we add back any expenses that didn't require the use of cash. So, in this class, the only two that we're going to have to concern ourselves with are depreciation and amortization. We did not have any amortization in this problem, so just add back the depreciation. Then the second adjustment is to take the non-operating gains and losses and take them out of the net income. So what would your net income be if you didn't have the $6,000 gain on the plant assets? It would be less. So you subtract the gains and you add the losses back to adjust for the non-operating activity. Then for the conversion from accrual to cash basis, if your current assets like accounts receivable go up by $4,000, that's an increase of 4. You want to go in the opposite direction of the change for the current assets. So that's an increase. We subtract it. The inventory went down, went from 120 to 118. So you add that, and the prepaids went up from 18 to 28. So you subtract that increase. For the current liabilities related to operating activities, you go in the same direction of the change. So this is an increase of 16,000 for accounts payable and a decrease of 9,000 for accrued expenses payable. 16 and 9. And you leave out the dividends payable, even though it's a current liability. It doesn't have to do with operating activities, it has to do with financing activities. Okay then, let's see. Now for the investing activities, you want to look at your investments, your property, plant, equipment, and your intangible assets. Don't have any intangible assets in this problem. We do have investments and machinery and equipment. So machinery and equipment was pretty straightforward. You started with $110,000 in the account, and then letter F says what? It says you sold machinery and equipment that had an original cost of $26,000, and letter H says we bought something that cost $44,000. If you subtract the sale and add the purchase, it comes out to $128. So there's no mystery. All right. So this here is going to be straight outgoing cash purchase. Now, the proceeds from the sale of the machinery equipment, you can't just use the original cost. You got to use the book value. So what is the book value? Let's go down here, find the book value. Lost control of the spreadsheet. Here we go. All right. The book value is the difference between the original cost and the accumulated depreciation. It's $17,500. Did we sell this for exactly $17,500? You say no, that would take all the fun out of the problem, right? So what did we sell it for? Well, we sold it at a gain of $6,000. So take the gain of 6 and the book value of 17.5. That should give us our number. And there you have it. 23,500. So those are two cash flows having to do with property, plant, and equipment. The investments, okay, that we had to do a little sleuth work. Started with 160, we ended with 159. So we know from letter, I'm not sure that letter is correct. Let's go look. We know, yeah, it is correct. Letter F, we sold an investment costing $23,000. Straighten out my letters over here. This is D. Okay, so we sold an investment that cost 23. That would have brought us down to 137 because we started at 160. But we don't end up at 137. We end up at 159. So the missing number is 22,000. That's purchase. That's going to be straight outgoing cash. Okay. Now the sale, we have to take the cost of the investment, which is 23,000, and add gain or subtract loss, and in this case I believe it's going to be subtract loss of 5,500, and that should give us our number 17.5. And we get the total for the category is 25,000. Now, in the real world, it's not necessarily a negative thing when you're spending money on investing activities, because hopefully you're doing things that will create additional profits down the line. All right, what's last is financing activities. All right, so it's going to have to do with basically our long-term debt and our stockholders' equity. So anything in here we want to look at. And it looks like some of our bonds have slid away. So apparently we paid off some bonds that had a carrying value of $80,000. But we didn't pay exactly $80,000 to get rid of the bonds. So we paid what? $80,000 plus $6,200. There was a loss on the transactions. And you pay more than the carrying value of a bond to pay it off, you have a loss. And that's usually the case. So let's go over here. Just drop that in. $80,000 carrying value plus the $6,200 loss. This could get really gnarly if you have a bond premium or bond discount, which would also affect our operating cash flows. But for this class, not such a big deal. All right, where are we? We are at the stock issue. So we want to look at these accounts here. And it looks like our common stock went up by 5,000. And it looks like our pick in excess of par went up by 26,100. So the combination of the two would tell you what the proceeds from the stock issue are. So we put that in there. Let's see, $5,000 increase common stock plus $26,100 increase in paid-in capital. And that should give us our 31.1. All right. And what happened with treasury stock? It's a contra equity account, and the balance went down. What does that mean in English? That means that we reissued treasury shares, which it says over here in letter C, at cost. So there you have, there's our $5,000 that we got from reissuing the treasury shares. And the last one we have to deal with is the dividends. So here's my dividends payable account, which if you look at the balance sheet, started with 0. And then the letter A, since we declared $85,000 in dividends, that would increase dividends payable. But that's not the number we want. The number we want is, well, how much did we pay? We only paid $82,000. So the short story is, if dividends payable goes up, that means you paid less than you declared. If it goes down, it means you paid more than you declared. So let's drop that in over here. 85,000 declared minus $3,000 increase in divs payable. Zip, zip. Total up the category. It's 132,100. And at this point, we're hoping against hope that if we add these three together, what three? Operating, investing, and financing, we get a number, and the number explains how we went from our beginning cash, which is 45, to our ending cash, which is 60, and it looks like it works, yeah? We have an increase of 15, which if you add to the beginning cash, that reconciles the ending cash. Zip, zip. So there you have it, Tatiana's tortellini. Okay then, let's move on to the financial ratios. I got a little 2-page, which if we had a real class or an additional class, it would be a handout. So there's a bunch of different things that we can calculate, which in theory will give us greater insight as to how well or how poorly the company is doing and whether or not it can pay its debts. So the first one's net working capital. So you take your current assets and subtract your current liabilities. Hopefully that's a positive number. If it's not, you've got some serious issues. So I got these two different companies here, Company A, Company B, and look at that, it's a miracle. They both have the exact same amount of net working capital, but that doesn't mean that they're both in the same condition in terms of debt paying ability. Also, this number, this dollar amount, doesn't give you really the insight you need. So you could have $150,000 in net working capital and not be in good shape. And you say, well, how could that happen? I got some numbers over here. Let's take this here, move it. This, let's say Company C, if you want a letter, Company C has what? $10,250,000 in current assets and $10,100,000 in current liabilities. They have working capital of 150. So all three companies have the same working capital, but this one's almost insolvent. All right, now, what's more revealing is when you look at your current assets in relationship to the current liabilities, and we got 2.5 times the current liabilities. It's known as your current ratio. The same thing for Company B. And in theory, once again, Company A and Company B are in the same condition. What about Company C? I got this number over here. How did we calculate that number? We took this number and divided by that number, and we got some really little number. So current ratio for Company C is this. What does that tell you? You got just a tiny little bit more of current assets than current liabilities, and that's generally not going to be a good deal. All right, so what's a little bit more revealing? So-called quick ratio, where you only use the quick assets in your numerator. That'd be up here. So I'm only going to use our quick assets. And what are the quick assets, you say? All right, so here's our quick assets. Our cash, trading securities. How far away from cash are those? Well, it's a click of the old mouse, and maybe the next day you have the money. Okay, the cash. Accounts receivable. Well, let's say you sell net 30. You probably collect that $85,000 in 30 days. So, Company A, Company B. They both have the same net working capital. They both have the same current ratio, but when you look at the quick ratio, you can see that Company A is in a better position. That's because Company B has a lot of their current assets in inventory, which in the real world, in practice, has killed many a company. The mismanagement of inventory. You could have lots and lots of money invested in inventory, and it might be the wrong items too, so you could have some serious issues. All right, so I think we're going to deep six Company B now and just look at Company A. And we got comparative balance sheets. Obviously, these are all made up numbers, but these numbers here are the same as was used above. 250,000 in current assets and 100,000 in current liabilities. All right, so there's our balance sheet, and I'm going to use that along with the income statement to make some other calculations and observations. Okay, first of all, accounts receivable turnover. All right, so what do? You take your net sales, that'll be from your income statement, and then you divide by the average the average accounts receivable rather. So there's our net sales from there, and then we look at beginning and ending balance sheet numbers, which are 91 and 85, and you find the midpoint between those two numbers is 88. Once upon a time, I used to make these calculations. We used to use 13 month ends to get that average AR. And you get 10.8. So what does that tell you? It tells you sell and collect, sell and collect, sell and collect your receivables almost 11 times a year, which is pretty good. All right, what else can we learn about accounts receivable? Well, if we look at the ending accounts receivable, which is 85,000, we can calculate, well, how many days of sales are incorporated into that number. So what do? Take our end of year, that'd be 2020, accounts receivable, and divide by the average daily sales, which is just what? That's going to be our 950 divided by 365, 2603 rounded. So we sell about $2,603 a day. We got almost 33 days in our ending accounts receivable. Is that a good number? That is a good number. If you're selling net 30 and this is 33, that means only a small fraction of your clients or customers are past due. So you're doing a good job of collecting your receivables here. These are pretty good numbers. Okay. Inventory turnover. Similar calculations. How many times do we sell and replenish our inventory a year? So instead of using your sales number, now using a cost of goods sold, 399,000. We're going to take that number and divide by the average inventory, which would be midpoint between these two numbers, looks like 52,000, yeah? So take your COGS of 399 and divide by 52,000. That's 7.7 times a year. Is that a good number? Well, that depends on what you're selling. If you're selling eggs and milk, that is not a good number. You want to have a very, very fast turnover of perishable items like that, which are usually low margin items. So if you can only get away with that kind of a turnover, if you're selling a product which has a pretty strong gross profit, in other words, you make a pretty good amount of money every time you make a sale. Okay, so that's 7.7. Let's see, what else can we do? We can calculate how many days sales we have in inventory, DSI. We take our end of year inventory, which is 50,000, and divide by our average daily COGS. So same idea that we did up here, but this time we're dividing the COGS by 365 plus divided by 365 should be 1093, and it is. You got 46 days in inventory, and that's a hypothetical number, because if you said, okay, I'm not gonna buy anything else after December, well, you'd run out of some stuff and not others. You can never sell out the inventory, but 46 days, all right, which kind of coincides with this thing over here, 7.67. Let's see if that's true. Take the year and divide by 7.67, it comes out to 48. So it's going to be a discrepancy because this is an average and this is just the year-end number. Again, this would be okay if you're making a strong profit every time you make a sale. Okay. What else do we have? Debt ratio. Heard the term heavily leveraged. What does that mean in English? That means that's a high number. Okay, so 40% is, generally speaking, not a bad number. That means that 60% of your assets are funded by stockholders' equity. Okay, so that's what that is. A heavily leveraged company might have 95% liabilities. Okay. Gross profit percentage. Well, this is something you should have done in accounting 1, maybe accounting 2 as well. You find the difference between what you sell your product for versus what it cost, and then you just divide, and it comes out to 58%. That's a really strong gross profit. I'd like to sell this item, whatever it is, okay? Because it's costing you $1. I'm sorry, you're selling it for $1. It costs 42 cents, and you have 58 cents left over. So let's find some of this stuff so we can sell it. Okay, 58%. Now that's something you want to keep an eye on, especially trend-wise, from one year to the next. Okay, because you could have competition that drives this number down. And also your costs could go up. So there's a lot of bad things that could happen which could make your gross profit erode. Profitability percentage is take your net income, divide by your net sales. That's a pretty strong number. In the real world, that'd be a strong number. And the most widely quoted financial statistic on the history of the Third Rock would be earnings per share. It's one that is quoted widely. How do you do that? Well, you take your net income and subtract your preferred dividends. Well, for this little illustration, there was no preferred stock, so there's no preferred dividends to deduct. Why would we take that out of the numerator? Because when we say earnings per share, we really mean earnings per common share. So the preferred dividends are not available to the common shareholders. We take that out of our numerator. We divide by the WACSO. That's my own acronym. Weighted average common shares outstanding. So that's not the shares at the beginning of the year, or the end of the year, or the middle of the year. It's an average of the shares outstanding throughout the year. Now in this problem, that's 20,000 shares, which was hopefully annotated on the balance sheet. So if you take 150 and you divide it in $1.50 and divide it into that number, you get 20, and it stays that way for the whole year. In any event, we get $3.85 a share. And the way it works in the stock market is, well, let's say this is the best year our company ever had. That's the best. Okay. And we come up with $3.85. Well, you would think, well, it's the best year we ever had, our stock price should go up. Well, if the Wall Street analysts had estimated $4 a share, that number is baked into the stock price, the estimated. And if we come in with $3.85, even though it's the best year we ever had, our stock price goes down. So that's how it works. Your stock price is based on expected earnings, and when your actual earnings differ, that's going to make the price either go up some or down some. All right, price earnings ratio, what do? You take the market price of your stock, which I believe is given, and you divide by the EPS, and that's 21.5 times. Now, is that a good number? Well, it depends on what kind of industry you're in. That is, generally speaking, a good number. And you see some crazy numbers out there, like maybe we could look at Tesla and see what their price earnings ratio is. It might be some gigantic number. So if you have a really, really high number here, like I remember at one time, Advanced Micro Devices had a PE ratio of like 100. And I thought that was really excessive, and sure enough, the stock price went from $40, and then we had that dot-com bubble bust, and it went down to like, let's say $4, gigantic decrease. So yeah, you can get away with higher numbers here if you're in an industry where there's anticipated explosive earnings going forward. Okay, this probably would not work for, like, say, a regional bank where they have very predictable and not volatile profits. So there you have it. There's more ratios, but those are the ones we're going to use. And where are we going to use them? We're going to use them for this little problema here. This is the Bardia Verte Saciole La Dolce Vita Limited. We got 3 balance sheets, and we got 2 income statements. And I made this little annotation here. And what does it say? You see how the bonds goes from 60 to 0? Well, if at the end of 2019 you knew that you were going to pay off these bonds, they would be, by definition, current liabilities. So we're going to play make-believe at the end of 2019 that you had no intention of paying these off and treat them as long-term in your calculations. You say, what calculations? These calculations down here, which are basically the ones we just went over. So have some fun with that. And then at the end of this week, we'll come up with our first comprehensive assignment submission, and then we'll move into some other really groovy stuff, time value of money and so forth. So that's all for now. If you have any questions or anything, just shoot me an email. I'm not going anywhere. Until next time.